Why gold could hit $23,000? James Rickards explains. Welcome back, this is Felix. Today we're diving deep into a bold forecast, gold rallying toward $23,000. That's the bold prediction by financial strategist James Rickards in a recent interview, and he argues it's just the beginning. In this video, we'll unpack his thesis, examine the risks, and see what this could mean for investors. Let's get into it. Context. First, some context. We're in a time of high global debt, chronic deficits, and monetary experimentation by central banks. Rickards contends that these factors create a tailwind for gold, especially as faith in fiat currencies becomes increasingly fragile. He sees gold not just as a hedge, but as a monetary asset reasserting itself in the modern era. The $23,000 gold view. Rickards' central claim, gold could reach $23,000 per ounce. That's not a random number. He sees structural imbalances, monetary debasement, and capital flows aligning to push the metal much higher. Key supporting points include central bank buying and accumulation, massive fiscal deficits and growing sovereign debt, currency debasement and inflationary pressures, a loss of confidence in fiat systems. He also argues silver will benefit in this trend, with strong upside from where it currently stands. Underlying assumptions and mechanisms. To evaluate Rickards' view, let's look at the underlying mechanics he leans on. 1. Debt spiral and deficit financing. Governments must monetize debt, pressuring currencies. 2. Central bank stacking. Gold as a reserve asset, a defensive hedge. 3. Monetary debasement. As fiat currencies lose credibility, gold regains appeal. 4. Safe haven demand and speculation. Capital flows seeking non-fiat assets. He frames gold as more than a commodity, as a re-emergent monetary anchor in an unstable environment. Criticisms and counterpoints. Of course, such a bold forecast invites scrutiny. Some counterpoints and risks to keep in mind. What if central banks tighten monetary policy aggressively? That could hurt precious metals. Inflation expectations versus actual inflation. If inflation stays low, gold's case weakens. Alternatives like cryptocurrencies, equities, or other assets competing for capital. Timing risk. Even if gold eventually rises, how long does this take? Geopolitical or regulatory shocks altering market flows. A prudent investor must weigh these headwinds when assessing such a moonshot price target. Implications and strategy. If Rickards is even partly right, what should investors or observers do? Some potential actions. Allocate a portion of portfolios to gold, precious metals. Use phased entry, dollar cost averaging into gold or related instruments. Consider gold mining stocks, ETFs, or physical bullion. Monitor macro indicators closely. Interest rates, inflation, central bank moves. Stay nimble. Be ready to cut losses if the thesis proves wrong. In essence, gold should be part of the toolbox, not the whole toolbox. Conclusion. To sum up, James Rickards makes a compelling, aggressive case for gold rallying toward $23,000. He sees structural global imbalances, monetary dilution, and loss of faith in fiat systems fueling this move. But the path is far from assured. Risks abound. What do you think? Is $23,000 gold realistic? Will silver follow? Let me know in the comments below. If you enjoyed this breakdown, hit like, subscribe, and ring the bell so you don't miss future deep dives. Thanks for watching, and until next time, stay curious and stay disciplined. This is Felix. See you next time.